Hello everyone, I am Hazel and I will be discussing modern portfolio theory and diversification. Let us know first what is modern portfolio theory. Modern portfolio theory was developed by economist Harry Markowitz in the 1950s. He is called the father of modern portfolio theory. His theory was first published in a 1952 paper by the Journal of Finance under the title Portfolio Selection, published by the American Finance Association. This theory was based on two main concepts. First, every investor's goal is to maximize return for any level of risk. It is a means to create and construct a portfolio of assets to maximize returns within a given level of risk, or to devise one with a desired, specified, and expected level of return with the least amount of risk. Second, risk can be reduced by diversifying a portfolio through individual unrelated securities. According to the modern portfolio theory, an investor must be compensated for a higher level of risk through higher expected returns. Modern portfolio theory employs the core idea of diversification. Diversification is a portfolio allocation strategy that aims to minimize idiosyncratic risk, or the risk inherent in each investment because of the investment's own unique characteristics, by holding assets that are not perfectly positively correlated, or that are perfectly negatively correlated. Negative correlation is demonstrated when a correlation coefficient is -1. It means that a positive movement in one asset is associated with negative movement in the other. For example, suppose a portfolio consists of assets A and B. The correlation coefficient for A and B is -0.9. The figure shows a strong negative correlation. A loss in A is likely to be offset by a gain in B. It is the advantage of owning a diversified portfolio. Modern portfolio theory stated that the risk for individual stock returns has two components. First, systematic risk, and the second is the unsystematic risk. Systematic risks are market risks that cannot be diversified away. Interest rates, recessions, and wars are examples of systematic risk, while unsystematic risk, also known as specific risks, are risks specific to individual stocks, such as change in management or a decline in operations. This kind of risk can be diversified away as you increase the number of stocks in your portfolio, as shown in this figure. It represents the component of a stock's return that is not correlated with general market moves. So in this figure, you can see that in the x-axis, we have the standard deviation or risk of portfolio return. And in the y-axis, the number of stocks in portfolio. So as the number of stocks in portfolio increases, the risk is being eliminated because of diversification. Now that we understand the benefits of diversification, the question of how to identify the best level of diversification arises. Enter the portfolio frontier, also known as efficient frontier. It is a set of portfolios that maximizes expected returns for each level of standard deviation or risk. Here's a typical illustration of efficient frontier. So we have the expected return, which is the expected value of the probability distribution of the possible returns it can provide to investors. Consider an investor holds a portfolio with $4,000 invested in asset Z and $1,000 invested in asset Y. The expected return on Z is 10% and the expected return on Y is 3%. The expected return of the portfolio will be 8.6%. Next, we have the standard deviation. Standard deviation measures the level of risk or volatility of an asset. It is used to determine how widely spread out the asset movements are over time. Assets with a wider range of movements carry higher risk. Next is the risk-free rate. Risk-free rate refers to the rate of return an investor expects to earn on an asset with zero risk. All assets carry some degree of risk. Therefore, assets that generally have low default risk and fixed returns are considered risk-free. An example of a risk-free asset is a 3-month government treasury bill. Efficient frontier. It is the upper portion of the curve, point A onwards. It is the combination of risky assets that maximizes expected return for a given level of standard deviation. Therefore, any portfolio on this point of the curve offers the best possible expected returns for a given level of risk. Point A, or the minimum variance portfolio, is the combination of risky assets that minimizes standard deviation or risk. While the point B is the optimal market portfolio, which consists of at least one risk-free asset. It is depicted by the line that is tangent to the efficient frontier, which is also called the capital allocation line. The capital allocation line is a line that depicts the risk-reward trade-off of assets that carry idiosyncratic risk. The slope of the capital allocation line is called the Sharpe ratio, which is the increase in expected return per additional unit of standard deviation. In the chart, at point P, the reward to risk ratio is the highest, and it is the combination that creates the optimal portfolio according to the modern portfolio theory. According to the modern portfolio theory, rational risk-averse investors should hold portfolios that fall on the efficient frontier. The optimal portfolio is the combination of assets at point B which combines one risky-free asset with one risky asset. Before I end my discussion, here are some important notes about modern portfolio theory. Modern portfolio theory argues that it's possible to design an ideal portfolio that will provide the investor maximum returns by taking on the optimal amount of risk. It also advocates diversification of securities and asset classes, or the benefits of not putting all your eggs in one basket. And proper diversification of a portfolio can prevent systematic risk, but it can dampen, if not eliminate, unsystematic risk. That would be all for today's discussion.